Hey, what's up everybody? It's Delta Edge here. Welcome back to the channel. Now, when it comes to growing your wealth, there are a lot of options out there. But one of the most common and often misunderstood are mutual funds. You see, I get it. There's a lot of noise out there about mutual funds, and honestly, some of it is just plain wrong. That's why today, we're diving deep into the top 5 myths about mutual funds. We're going to break down why these myths are holding you back, and more importantly, how you can start building wealth through mutual funds, even if you're starting from scratch. Oh, and stick around till the end for a chance to win a reward worth 21,000 rupees and claim 10 free financial calculators that'll help you on your investing journey. Alright, let's jump right into the first myth. Mutual funds are only for experts. This couldn't be further from the truth. Look, I understand where this myth comes from. The world of finance can seem really intimidating, right? With all the jargon and complex strategies, it's easy to feel like you need a finance degree just to dip your toes in. But here's the thing about mutual funds. They're designed for everyone, regardless of your financial expertise. Think of a mutual fund like a basket of stocks or bonds. When you invest in a mutual fund, you're essentially pooling your money with other investors to buy into this diversified portfolio. This means you get instant diversification. You're not putting all your eggs in one basket. And the best part? You don't need to be a stock-picking guru to get started. Mutual funds are managed by professional fund managers. These are the experts who do the research, analyze the market, and make investment decisions on your behalf. It's like having a personal financial advisor, but at a fraction of the cost. Now, I know what you might be thinking. But Graham, don't I need to know a lot about different stocks and bonds to choose the right mutual fund? Not necessarily. There are tons of resources available, like online platforms and financial advisors, that can help you identify funds that align with your financial goals, risk tolerance, and investment timeline. Remember, investing in mutual funds is all about making your money work for you, not about spending hours every day analyzing market trends. It's about taking a simple, accessible approach to building long-term wealth. So, ditch the myth that mutual funds are only for experts. You don't need to be a Wall Street whiz to get started. Let's move on to the second myth that's probably holding a lot of you back. You need a lot of money to start investing in mutual funds. This myth is so common and so wrong. It's time we debunk this once and for all. Look, I get it. When you hear about investing, you might picture those Wall Street guys in suits throwing around millions of dollars. But the reality is, you don't need a small fortune to get started with mutual funds. In fact, you can start investing in mutual funds with as little as 500 rupees. That's right, just 500 rupees. That's less than what you might spend on a fancy coffee and a pastry. And the beauty of it is, even small investments made consistently over time can grow significantly thanks to the power of compounding. Think of it like this. The earlier you start, the more time your money has to grow. Even if you're only investing a small amount each month, those small contributions can snowball into a significant nest egg over the long term. It's like planting a seed. The earlier you plant it, the more time it has to grow into a strong, healthy tree. And here's another thing. You don't need to make lump sum investments. Many mutual fund companies offer something called systematic investment plans, or SIPs. With SIPs, you can invest a fixed amount of money at regular intervals, say monthly or quarterly. It's like setting up an automatic savings plan, but for your investments. So, if you've been putting off investing because you think you need a lot of money, don't wait any longer. Start small, start early, and watch your money grow over time. Chapter 3. Myth 3. Mutual funds are too risky. Busted. Now, let's address the elephant in the room, the myth that keeps so many people on the sidelines. Mutual funds are too risky. Now, this one's a bit trickier because, well, all investments come with some degree of risk. But here's the thing. Not all mutual funds are created equal. Just like there are different flavors of ice cream, there are different types of mutual funds, each with its own risk profile. You've got your equity funds, which invest primarily in stocks. These funds have the potential for higher returns, but they also come with higher volatility. Then you've got your debt funds, which invest in fixed income securities like bonds. These funds generally offer lower returns compared to equity funds, but they're also less volatile. And then you have balanced funds, which invest in a mix of stocks and bonds, offering a balance between risk and return. The key is to choose a mutual fund that aligns with your risk tolerance. If you're young and have a longer investment horizon, you might be more comfortable taking on more risk with a higher allocation to equity funds. But if you're closer to retirement and need more stability, you might opt for a more conservative approach with a higher allocation to debt funds. And here's another thing to remember. Diversification is your best friend when it comes to managing risk. When you invest in a mutual fund, you're automatically diversifying your portfolio across multiple stocks or bonds. This diversification helps to spread your risk, so even if one investment doesn't perform well, it's less likely to tank your entire portfolio. So, don't let the fear of risk keep you from investing in mutual funds. Do your research, understand your risk tolerance, and choose funds that align with your financial goals. Remember, the biggest risk is not investing at all. Chapter 4. Myth 4. Mutual funds have high fees. Busted. Alright, let's talk about another myth that seems to pop up all the time. Mutual funds have high fees. Now, it's true that mutual funds charge fees for managing your investments. These fees are called expense ratios, and they cover the costs of running the fund, like paying the fund manager's salary and other administrative expenses. But here's the thing. Not all mutual funds have high fees. In fact, many mutual funds, especially index funds and ETFs, have extremely low expense ratios. And even a small difference in fees can make a big difference in your returns over the long run. Think of it this way. Every rupee you pay in fees is a rupee that's not working for you. So it's important to be mindful of fees and choose funds that offer a good balance between cost and performance. Now, how do you find these low-cost funds? Well, there are a ton of online resources and financial advisors who can help you compare different funds and their expense ratios. You can also look for funds that are passively managed, like index funds, as they tend to have lower fees than actively managed funds. And here's a pro tip. Don't be afraid to negotiate fees with your financial advisor. Many advisors are willing to lower their fees if you have a larger investment amount or if you're a long-term client. Remember, knowledge is power when it comes to investing. So, don't let the myth of high fees scare you away from mutual funds. Do your research, compare different funds, and choose options that offer a good value for your money. Chapter 5. Myth 5. You can't withdraw your money. Anytime. Busted. Finally, let's address the last myth on our list. You can't withdraw your money anytime from a mutual fund. Now, this myth stems from a misunderstanding of how mutual funds work. While it's true that you shouldn't treat mutual funds like your everyday checking account, they're not meant to be a lock-and-key investment either. Most mutual funds are highly liquid, meaning you can buy and sell units of the fund on any business day at the net asset value, NAV, of the fund. This NAV is calculated at the end of each trading day based on the current market value of the underlying securities in the fund. So, if you need to access your money, you can simply put in a redemption request with your mutual fund company, and they'll liquidate your units and credit the proceeds to your bank account, usually within a few business days. Now, there might be some exceptions, like closed-ended funds or funds with lock-in periods, but these are usually clearly stated in the fund's offer document. And even in those cases, there might be provisions for early redemption under certain circumstances. The key takeaway here is that mutual funds offer a good balance between liquidity and growth potential. You can access your money when you need it, but you also benefit from the potential for long-term growth. So, don't let the myth of illiquidity keep you from investing in mutual funds. Understand the redemption process, choose funds that align with your liquidity needs, and enjoy the best of both worlds. So there you have it, folks. The top 5 myths about mutual funds, debunked. I hope this video has given you the clarity and confidence to start investing in mutual funds and building long-term wealth. Remember, investing doesn't have to be complicated or intimidating. With the right knowledge and approach, anyone can do it. Thanks for watching. If you found this video helpful, don't forget to give it a thumbs up, share it with your friends, and hit that subscribe button so you don't miss out on any future videos. And hey, to claim your reward worth 21,000 rupees and get 10 free financial calculators that'll help you on your investing journey, just send a WhatsApp screenshot of this video to the number in the description below. I'll see you in the next video.